So you guys know that I'm a huge fan of index-based ETFs, right? Like the S&P 500, Nasdaq 100, et cetera, et cetera. Many of you watching are also fans, of course. What's not to like? Passively managed, automatic diversification, automatic rebalancing, right? The bigger companies are always going to get the bigger chunk of the assets in the fund, low cost, et cetera, right? We all love them. But you guys also know that I'm a fan of 25% leveraged ETFs, right? 25% leverage. Why do I like it so much? Well, if you're like me and you're going to be investing in things like the S&P 500 or Nasdaq 100, quality assets that typically rise over time, if you add a little bit of leverage, that could potentially enhance your total returns over time. Also, this is hands-off leverage. It's not you borrowing the money, it's the fund manager. Of course, they get better rates, better interest rates or borrowing costs than me and you can. And it's only a little bit, it's 25%. So yes, leverage does increase your risk and volatility, but 25% is really light and modest leverage, which could go a long way over time. So yes, I also like adding covered calls. I invest in covered call ETFs as well. But what if you're a growth investor and you don't want the covered calls on these ETFs, but you're still interested in the 25% leverage, right? You don't need the income right now. You don't want a cover call overlay on the ETF, but you're interested in those index ETFs, for example, and wouldn't mind maybe, we're thinking about maybe having that a 25% leveraged version, which could enhance your potential growth and performance over time. Well, in case you didn't know, Global X has 25% leverage versions of not only their covered call ETFs, or most of them, but also their passive index growth ETFs as well, and they don't have the covered call. So these could be very interesting to consider if you're a growth investor, or even if you're an income investor who wants to add a little bit of growth ETFs in there. And if you're a long-term investor, you're in it for the long term, and you think, for example, the S&P, Nasdaq, these assets are going to go up over time. Well, having a little bit of leverage, 25% leverage, could potentially be a good idea over the long term, especially how low borrowing costs are. So let's take a look at some of these ETFs, which are a little bit newer, they're a little less known, but I really think they shouldn't be ignored, especially if you want to potentially enhance your growth and total return over the long term. Let's check them out, guys. When it comes to index-based investing, everyone, Global X Canada has you covered. They pretty much have the major indexes covered. So you have the TSX 60 here, which in my opinion is kind of like the Canadian S&P 500, right? Top 60 publicly listed companies in Canada. You of course have the S&P 500 with USSX, the Nasdaq 100 with QQQX. You also have the international ones like the MSCI EAFE for international developed markets, EMMX for the MSCI emerging markets. They also have HEQT if you just want a combination of all these indexes and get access to top stocks or the top indexes all over the world, right? So it's very interesting what Global X has done. So yes, they have 25% leverage versions of their covered call ETFs as well, but we're not focusing on that. On all these growth index-based ETFs that we just went through the list here, they have 25% leveraged versions without any covered call. So these are really designed for growth investors. So in CNDX, the leverage version is CANL, that is the stock symbol. And basically you'll see that, and you'll see this as a theme as we go forward. It's the same name as the corresponding index ETF. They just added enhanced in the name of the ETF, and that is where the 25% leverage comes in. So you're getting magnified or 25% exposure to CNDX, just like it says here. And if we actually look at the holdings, what does this ETF actually hold? Approximately 125% of the Global X TSX 60 index, which is basically CNDX. So for USSX, you just change that X to an L and you have the enhanced S&P 500 index. For QQQX, you guessed it, change the X to an L. Once again, you have the 25% leverage version here, a NASDAQ 100 with QQQL. And we could go down the list, right? EAFX for the MSCI EAFE index, if you're interested in developed markets outside North America, like Europe, Japan, Australia, well, they have EAFL, the enhanced version. And of course, for all of these, if you look at the holdings, you'll basically see the same type of deal, approximately 125% of the underlying one without the leverage. So you have 25% approximately more exposure. Same thing for the emerging markets, EMMX, change that X to an L, you have the enhanced version. And if you want the whole world, right, they have HEQT, which is a combination of many of these indexes that we just saw, right? You have a combination of indexes here, most of which we already just reviewed, and the combination basically gives you access to the top stocks, the top indexes all over the world. Well, guess what, everyone? This is very popular, right? It's a one-stop shop, if you will, if you just want the best stocks and you want global diversification, you want geographic diversification. Well, guess what? They have a leverage version, and once again, just change the last letter to an L, HEQL, and you have the enhanced version. And if we look at the holdings, of course, you'll see that it basically, once again, has 125% access or 125% exposure to HEQT. So these are really the major indexes to get you covered all around the world, even the all-in-one, right, with the HEQT and now HEQL, the leverage version. And on top of that, they also have one for the 6 banks. Investing in the 6 banks is very, very popular for us Canadians, right? So they have HBNK, which is just equal weight 6 banks. You have the 6 banks equal weight. A great way to, instead of picking and choosing the banks, you just get this ETF for all of them. Well, guess what, everyone? They also have a 25% leverage version of that one as well with BNKL ETF, right? So, and again, it has 125% exposure to HBNK. So, one thing you'll notice is that the management fees of the leverage versions are slightly higher, right? You see here 35 basis points. And if we look at, for example, the one without the leverage, you have a much lower management fee. Right now, this one's on, I guess there's no management fee for this one right now. If we look at the S&P 500 one, USSX, the management fee is 0.08. The leveraged version is 35 basis points. So the management fees are going to be a little bit higher because they're managing the leverage. So it's only normal that the management fee could be a little bit higher. Another thing you will notice, and a lot of people get thrown off by this, is that the MERs are much higher compared to the non-leveraged version, right? You see the MER is 0.09 for the S&P 500 without the leverage, but it's 1.35 for USSL, the one with the leverage. Why is that? Well, that is because the leverage costs, the borrowing costs, are integrated in the fund, are integrated in the MER. So it's completely normal that the MERs are higher on these ETFs because they include the leverage costs. So the $1 million question now, and this is what we're going to take a look at right now, because a lot of these have been out for over a year, so we actually can discuss and look at performance. How has USSL performed, the leverage version, over USSX? And what about the TSX 60? And what about the other ones, right? HEQT versus HEQL. Well, I have the data. Let's check it out right now. So the portfolio managers at Global X have been kind enough to send me the actual total returns for a lot of these ETFs. So basically what we're doing is we're pinning the non-leverage version to the leverage version, and you have the dates at the bottom here. This is for a specific date, but of course we're using the same start date and end date. And you could see for the TSX 61, which is a representation of overall Canada, you see that the one in orange is CanL, which is the 25% leverage version, and you see that it has higher total returns, right? 17 versus 20, right? So the one in orange, the leverage one, has higher performance during this time period that you could see at the bottom. If we go to the next one, this is the S&P 500 one. It's the same type of story. You see USSL has higher performance, right? If we look at the NASDAQ one, NASDAQ 100, QQQL versus QQQX, same type of story, higher performance. Even the one that has all of them, right? The global one, the one that has a lot of these indexes gives you access all over the world. HEQT versus HEQL. You could see that HEQL, the leverage version, is outperforming. And remember, guys, this is performance. This is net or after fees, including that higher MER cost, right? So this is just to prove to you, everyone, that yes, the market has done really, really well during this time frame. And if you're a long-term investor like me and you expect the market to do well over time, it's most likely, I'm not going to say it's possible, it's most likely that the leverage version, if you're adding a little bit of leverage to that asset that goes up over time, you're going to do better than holding it without the leverage. This is my opinion that I'm saying. It's my opinion, not Global X's opinion, but the proof is in the pudding. And by the way, you could check out the 1 year performances yourself, right? If we look at CNDX, you go to 1 year performance here as of May 31st, it's 21.11. What about the leverage version? 25.05. S&P 500 with no leverage, 13.99 the last year. If we look at USSL, 15.70. So you're starting to see the trend. So quick performance update on these 4 ETFs, everyone. As of June 30th, 2025, you have CNDX, the TSX 60 index without leverage, 26.05 versus CAN-L, the 25% leverage version, 31.43. For the S&P 500, USSX, the 1 year performance, 14.29%, and USSL, the 25% leverage version, at 16.28%. My opinion, everyone, these should be ETFs that you should consider if you're a long-term growth investor that doesn't mind a little bit more volatility. Of course, when you're adding 25% leverage, you're going to get more volatility, 25% approximately more volatility. But if you're a long-term investor, you should be able to stomach that, in my opinion. Think of the long term. And obviously, if you think that the overall markets, like these index funds, is what they do, they capture the overall market in Canada or in the United States or all over the world, like this one here, like HEQT and HEQL. Well, most likely the leverage ones, my opinion here, they're going to outperform the ones that don't have the leverage, thanks to very low borrowing costs. And remember, again, this is hands-off leverage. So I think you should strongly consider them. That's my opinion. Even if you're an income investor like me and you want to add a little bit of growth, some people like to mix and match. These could be really cool ones to consider, in my opinion. Don't forget to check out my other videos where I cover, for example, the leveraged covered call ETFs that Global X has. They have an entire lineup of index-based covered call ETFs and 25% leverage versions of those ones as well. So I'll put the links to these videos in the video description below. So let me know if you have any questions or concerns. Give me a thumbs up. I would really appreciate it, and see you next time.